Is the Federal Reserve losing its magic touch when it comes to interest rates? For years, slashing rates has been the go-to move for boosting the economy, but in today's debt-driven, unequal landscape, it might not pack the same punch. Meanwhile, the wealth gap between the haves and the have-nots is increasing substantially. So what's left for the Fed? Maybe it's less about the economy and more about managing government's ballooning debt. Let's talk about this. All right, welcome back to another deep dive. My name is Mike, and my goal with these videos here are to keep you informed, up to date, and one step ahead of the mainstream narrative. And so, of course, this current environment we're in now, it's all about the Federal Reserve and what will they do. And so the market hinges upon the Federal Reserve action and their forward guidance as to how they're going to control this narrative that they're putting out there. And so I'm always going to be talking about things that are relevant in the hopes of trying to keep people one step ahead. So as always, if you guys want to hear more of these little short analysis, definitely hit that thumbs up button. Make sure you subscribe. And more importantly, leave a comment down below so that I know that it's actually reaching people and you're learning from these little short videos here. And then also, as just a heads up here, stay tuned because I'm looking to actually dive deeper into daily analysis with some live streams and whatnot. So definitely be on the lookout for that because I'll be doing those as much as I can just to connect the community directly whenever I can. So you're definitely going to want to join us for those when they're available. So to the most pressing concerns that we have, it's definitely this financial landscape we're in because all eyes are on the Federal Reserve with everyone speculating about the next move on interest rates. So the question is, will they cut? By how much? When? Where? How? Those are all things that people are really focused on. But here's the catch. We might be asking the wrong question altogether. The real issue could be that the American economy is far less responsive to these rate cuts than many assume. The way the U.S. debt is structured plays a significant role in this whole equation, leading to potential consequences that most people seem to overlook. And so something to consider, are rate cuts losing their punch at the end of the day? Because traditionally, rate cuts were seen as a powerful tool to stimulate the economy. However, the current structure of the American debt, being at 35 trillion and climbing by almost 1 trillion every 100 days or so, and particularly with the long-term fixed rate mortgages, means that the impact of these rate cuts are more muted than in the past. Most homeowners refinance at historically low rates in recent years, locking in payments that won't change regardless of what the Federal Reserve does next. So this fixed rate environment shields a significant portion of the population from rate changes, which renders this tool less effective in stimulating economic activity. So ultimately, the average consumer will end up borrowing less because they're already tapped out, while the uber wealthy will continue to borrow at eventual cheaper rates, purchasing assets that will only increase their wealth, creating more of that wealth divide that I mentioned earlier. So this disparity between the different income groups also plays a crucial role. And so in the US, consumer spending is heavily driven by wealthy segments of society. Many of these individuals are benefiting from the stable, low rate mortgages while also seeing increased returns on their savings as rates rise. This effectively boosts their spending power even as borrowing costs increase. For those on the lower end of the income spectrum who are most likely to rely on short-term debt and variable rates, the situation is much tougher. They face rising costs without the cushion of locked-in low rates or growing savings returns, further exacerbating the wealth gap. Now, let's not forget the corporate debt issue we also have, because the corporate sector mirrors this situation. Larger U.S. corporations, particularly those in the tech sector, often secure long-term fixed-rate debt through the bond market. This shields them from rising interest rates, much like affluent homeowners. Additionally, these corporations often hold substantial cash reserves in interest-bearing accounts, meaning they actually benefit from higher rates. This situation creates a paradox where the rate hikes intended to cool the economy could actually stimulate the wealthiest individuals and the largest corporations. And so because of all this current moment is probably worthwhile to begin questioning the Fed's overall strategy and their approach, because therein lies the problem. Given all this backdrop, it's worth questioning whether the Federal Reserve's traditional approach to monetary policy is losing its effectiveness. See, rate cuts, which once spurred refinancing booms and boosted consumer spending, may no longer have the same broad impact overall. So the structural shifts in spending patterns mean that the benefits of these cuts are concentrated among a smaller, wealthier segment of the population, leaving many others unaffected. So why might the Fed still consider cutting rates? Beyond stimulating the economy, there's a significant financial incentive, which is managing the cost of the government's own debt. As of right now, the interest payments on the government debt has exceeded over $1 trillion a year. And that, my friend, is unsustainable. So with the soaring national debt, high interest rates increase the burden of servicing this debt. So lowering rates could provide relief for federal finances, suggesting that the Fed's decision may be influenced as much by fiscal concerns as by economic conditions. And so as a result of this, there's another concern, which is global capital flows. So over the past decade, U.S. equities, especially in the tech sector, have attracted enormous amounts of global capital. But as these assets become overvalued, there's a growing risk that capital will start to flow elsewhere. Therefore, emerging markets, which have been squeezed by a strong dollar and a tight monetary conditions, could become the next hotspot for global investors. But yet, these shifts in global capital flows don't happen overnight. They're often triggered by changes in monetary policy or economic conditions. So if the Federal Reserve eases up on rate hikes or even begins cutting rates, we might see a shift away from the U.S. assets towards undervalued markets abroad. So this could also lead to renewed interest in commodities such as gold and silver, which traditionally perform well in weaker dollar environments. So with all that being said, The main point is to begin adapting to a new economic reality. As the Federal Reserve navigates its next move, it's clear that the traditional playbook may no longer apply. The unique structure of American debt, combined with growing income inequality, has created an economic environment where rate cuts may no longer drive growth like they have in the past. So that means investors and policymakers need to reassess their strategies, recognizing that the American economy might be desensitized to the very tools that were once a lifeline. So there you have it, a different spin on how this whole rate policy situation could become more of a problem globally speaking than what we're focusing on here in this country here. And so because of all this debt here, the Federal Reserve are literally walking a very tight line of trying to figure out how to maneuver without breaking something, or perhaps something that's already broken the moment they cut on the monetary spigot and created over $6 trillion over the last 4 years to deal with the health situation we had. And so now we're starting to feel the ripple effects of that. Therefore, it's going to be a lot more strategic manipulation of markets via the policies to make sure that they don't lose control. So what does that mean for you and I? It's simple. While they're trying to do all these shenanigans behind the scenes, trying to pull levers here and there to make sure they keep things going straight, we all know this at some point it's going to be derailed. It's going to come off the hinges, and you don't want to be a casualty of their policies. So therefore, understanding monetary history, knowing that this experiment can't go on forever, and then taking action to be proactive with what you do, realizing that in the midst of all this, the greatest threat to your financial future is this instrument right here. So if you base your entire lifestyle and your financial future on this, you will be the victim, because this is the tool of choice that they're trying to use against the world, as well as against those that are monetarily uninformed within this country that base everything upon this. So they're going to create a lot more of this to try to prop the system up. So that means you want to make sure you diversify away from these things by simply redeeming them, which is what these notes were originally intended to do. And how do you do that? It's simple. Get you some of these things here. Get you some silver, get you some gold, get you some real sound money, and you'll be one step ahead of all the chaos that's probably going to ensue within the next couple of months and years. So anyway, just checking in, sharing my 2 cents on some things. Curious to hear what you think. Leave a comment down below. If you found value, share this so more people can find out what's going on and get an alternative take on everything. Because once again, the goal is to keep you one step ahead. And with this information here, I think I did my job. Other than that, catch you guys later. Peace.